Media recognition from Bloomberg, Reuters, recycling trade publications. Patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is market historian Bob Hoye. He's the chief investment strategist for ChartsAndMarkets.com. He's speaking to us from Vancouver. Welcome back to the show, Bob.
Yeah, hi, Jim. Here we are. It's Friday, and in the States and elsewhere, spreading out of the States, it's called Black Friday, and not because of the action in the stock market today, but because of their special sales, and then the retail business gets out of operating in the red and begin to operate in the black, meaning on the positive side, and their best times of the year are Easter and then from now into Christmas. And that's the way the retail side works. And we also have some black action in the financial markets.
Wednesday, you wrote about this, saying, just explain what you wrote on Wednesday. I don't want to paraphrase.
Actually, it began 2 weeks ago when some of our charts were looking precarious, but not quite broken down. So I wrote it all that was required. And, of course, comparing to the end of previous great financial bubbles, such as 1929 or 1873, even back further, like the first great financial bubble was in 1720, and each of them has had common characteristics, and we'll just go through them. One is in the final stages of the mania, real copper prices go up, and ironically, the real price for gold, adjusted for inflation, it goes down. And then also you have the real long interest rates. Again, that's the rate of interest adjusted for inflation, and they go down in a bubble. And in three previous bubbles, they actually got to minus real, sort of -5 or -6%. And recently, the long-dated U.S. Treasury traded down to -3% real. So that's in line. And then the other one you get is that the senior currency, which is still the U.S. dollar, it can be sort of weak during the final part of a great financial mania, and then it starts to turn up. So that was the basis of this study, these key, reliable features of a great financial mania. And so then I waited it took a couple of days to put all the charts together, updated and all that sort of stuff. And they were key items such as credit spreads had broken out to widening. Another one, the gold-silver ratio, it in a boom, the ratio declines, and then in a bust it goes up. We've called that the metallic credit spread. So all these things have changed, and crude oil hasn't been around as long as copper, but copper is now getting trashed. And today, crude oil is down something about 11%. Now, when I saw these breaks earlier today, I hadn't looked at any news, and I thought, ooh, this is going our way. And then I looked at the news, and it's a sudden scare about a variation of the COVID thing, and the market's expecting another lockdown. So, but one can measure the conditions in the financial markets, and then from that make the conclusion that the action was very precarious. But you can't predict ahead of time the explanation that the media will put on the break in the market when it occurs. So when you get this and they're tying it to lockdowns and shutdowns and everything else, it's made it very dramatic. This is very painful. There will be major hedge funds and trading funds and things like that very much on the wrong side of this reversal here. And also, when we've been talking, Jim, and been mentioning that the big buzz has been about, it was 1970s inflation was going to come back again, and you were then going to be short dollars and long things. And so that put a hell of a bid in not just the industrial commodities, but also into the precious metals that were not too strong, but the bid was there. So this now is become a disastrous position very quickly. So the amount of damage that is being done is incredible. And certainly maybe at the moment it's kind of getting overdone when you've got crude oil down 12% in one day. But I think it has broken the spell of the party. And we'll see how it goes for the rest of the things. But when I finished the study yesterday, the reversals in these key things were only, just started. Like enough to say, oh, I'll get this piece published. And then as of today, it's enough now to get the attention of everybody around the world. It is really a serious break. But fortunately, it's in the right direction. So, as I said, Jim, there will be some major funds out there on the wrong side of this, and you could have a fair amount of distress. And in my mind, this hit was deserved because of the excesses accomplished recently, and one can't determine how fast it's going to be. And then when the media put this label on about another lockdowns and stuff, that then becomes irresistible, and some very forced trading going on there. But it's the right direction at, I guess, the right time, following measurable excesses. I mean, these are, fortunately, with our technical analysis, you can measure these things. Like we just doing one here today on yet another hot commodity going straight up, which has been coffee. So Ross has done it up, and coffee straight up to technical excesses. So you just wonder, hey, is today the high, or can it go into next week or following? But you can at least measure the technical excesses. And it reminds me of the Julie London song in the 1960s called Black Coffee. It's really a good one. And so even then, we've got these rotations from earlier in the year, very strong corn and soybeans, and they went up, became technically excessive and cracked. Lumber was absolutely outstanding. And then more recently in September, you had hot action in crude oil and natural gas, also aluminum. So there were, and it looked like a rotation where all of a sudden something becomes the favorite, goes straight up and gets overbought. And there's not an amusement here. Coffee is straight up and overbought. And as yet another example of this kind of action that's been going on for over the last year. So we'll watch and see where it goes, Jim.
Well, Bob, you're a technical analyst here when you take a look at the markets. Christopher Mullen, friend of the show, along with Tim Cyclesman Wood. They're two people who never watch the news. They just take a look at trends, what the markets are doing, how they've reacted in the past in similar situations. That's how they set up their trades. So they wouldn't know anything about this alleged COVID variant headline being blamed for everything. But then we might as well, blame the Washington football team for not having a nickname.
Right. Well, in 1929, for example, in London, there was a guy had become very successful in putting deals together and speculating, and Clarence Hattree was his name, and he was putting together a major steel company in England. And early in 1929, he had enough promises of financing to be able to do it. Then as the year progressed, his backers kind of got cold feet. And then in the summer, he knew that he was toast, so he sent word to the governor of the Bank of England saying that if I go down, the market goes down, give me some help. The bank was not going to respond to that. But the market, it was overbought enough that it was going to fail anyways. So then they financial journalists had to have somebody to blame. So they blamed Clarence Hattree. Now then, in the 1873 bubble, New York was a highly speculative market and then becoming an important market. So when it failed, the economist in London blamed it on excessive speculation in New York. And the writers have to come up with an explanation, but there's actually a nuance in the 1873 bubble, because at that time there was the undersea telegraph cable from New York to London and then London to Paris, all that kind of stuff. So again, in The Economist, I remember making notes about this, that at the first crack, the opinion was that with the telegraph cable now, liquidity could be wired from London to New York, and that would then provide liquidity which would stave off the collapse. It collapsed anyways. And then afterwards, there was a storyline that, perhaps the undersea communications of the undersea cable were instantaneous, and it spread the bad news. So whatever goes on, somebody will have an explanation for it. So yesterday when we published our piece of warning, well, as a matter of fact, Jim, the title was called Global Warning. Not warming with an M as in mother, but global warning. And we did one, October 19th, 2007. Not as elaborate, but it was one of these global warnings. And the high in the market, I think, for the S&P was October the 12th, so it was a week or so after the event. So, but anyways, it was what you look at is that the conditions were becoming so extreme that then I decided 2 weeks ago to write up a very special piece on it, and then spent the last 2 days updating the charts on it with the emphasis and that sort of stuff. So anybody wants to look at the study, they can just get in touch with you or me at bobhoye.com, and we'll be glad to get it out to you.
Now, of course, Bob, they're blaming some coronavirus COVID variation in Africa. They don't even know if it's a bad variant. It may be even better. It may just cause like a mild runny nose. They don't know anything about it, but to claim there's panic. Now, Bob, in the past, the fallback blame for everything bad in the market was tension in the Middle East. There's been tension in the Middle East for the last 10,000 years. And today, I would say, Bob, they would blame the tension between China and Taiwan. I'm surprised they didn't use that as a reason for the market drop.
You know what my standard advice is? Stay indoors and drink lots of fluids.
It always works. We'll have more with Bob Hoye right after this.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Bob Hoye. And Bob, as the stock markets have gone down today, Bitcoin and other cryptocurrencies have also had a major correction. And Chris Haddock, friend of the show, who's been on This Week in Money with us and sometimes just on House Street on a regular interview, has pointed out that Bitcoin follows the S&P almost step for step. So if the S&P is on the way up, so is Bitcoin, and when the S&P goes down, so does Bitcoin. So I follow those markets as well as everybody else. Not that I'm involved in them. I'm not rich enough to lose my money.
Well, I did a study on the Bitcoin a while ago, and essentially it was that it ended up being like a stock, but it cost huge amounts of money to create what is the equivalent of a stock certificate. Now, in the old Vancouver Stock Exchange, I recall at one time, it cost you 25 cents a share to create stock certificate. And then hopefully you would be selling them as high as possible. But it is one of the most incredible items ever to appear in the financial markets. And over the centuries, some of the promotions have been phenomenal, but there's been nothing like this one. It's extremely costly for all this electricity to create what is the equivalent of a stock certificate, and it'll act like a stock certificate. And as you said, friend of the show points out that it does trade off of the S&P moves, and we'll just see where this thing goes. But where I'm impressed as a historian is that with the South Sea bubble of 1720, the key stock was a quasi-government company called the South Sea Company, and it went from £100 to £1,050 in a year. Let's just say a 10-timer. And then maybe on the RCA, Radio Corp of America, in 1929, I'd have to look at it more closely, but maybe a 10-timer was the best on that. Now, within these highly speculative markets, you can have a mining stock can catch the attention of the world, in which case it goes from pennies to pounds to maybe 10, 20 pounds or something, and you then, because of the penny start, percentage gains are immense. But with the Bitcoin crypto stuff, you have huge market capitalizations with percent gains that are orders of magnitude greater than just a mere 10 times. So this then, to me, Jim, points out that the really hot inflation has been in financial assets, and then that's on the equity side. And then on the bond side, you've got the amazing thing that in Germany, their 10-year note got down to almost minus 1% nominally, and that a minus percent on a nominal interest rate has never happened in history before. So these 2 points, Bitcoin and the German nominal yield getting to minus, is incredible evidence that the really big action, the huge inflation, is in stock and bond prices. Mm-hmm. And I'll stay with the opinion that the rise in industrial commodity prices, such as copper or lumber, they are part of the business boom that is associated with the final phase of a great financial bubble. So, and then, as we said, we've got all of the key items for a great bubble became very excessive in doing the right things at the right time. And then now in reversing, they're suggesting that the bubble is over. And me being the old historian, I kind of got to agree with what the evidence is showing. But for us, on a more practical stage, Jim, we have a technical tool that in a flat to rising market for the S&P is that, you get the dips and everybody buys the dips. Well, this thing gives us, we call it the springboard buy. So it just technically confirms that, the dip is maybe about as far as it's going to go. Well, the last dip that we got a springboard buy on was in early October, and you've had a terrific rally for the S&P since. And then our line in the sand is that no matter what other items we have showing the ending action, we really want, you can't declare a bear market until the S&P takes out the last springboard buy, which was in early October. And forgive me, I can't remember the level in the S&P then, but today's hit is severe, but it has a way to go before taking out the October low, but we'll be watching it closely. Mm-hmm. So, Jim, we live in very exciting times.
Yes, and getting back to Bitcoin and other cryptocurrencies, China banned Bitcoin, I think, a year ago, then just recently said, well, it's okay to trade in it again. And today I get news from the Bitcoin information site that Chinese crypto censorship reaches media outlets. So now the media in China is not allowed to mention cryptocurrencies or Bitcoin, and domestic IP addresses in China have also been blocked if they try to access their Bitcoin account or trade in it. Perhaps with this drop in Bitcoin, China doesn't want people to pull their money out of it because they've put so much of their money in it.
It's hard to figure out what communists are doing, but I think the Communist Party individually has all been, or the party has been in favor of the boom because you have a certain prosperity going with it. And then quite likely probably individual members of the leadership are probably personally long boom stuff and are worth hundreds of millions of dollars, and they want to keep it going. But then also, I think in coming out with cautionary statements are trying to cool things rather than drive it down. And the market's going to roll over on its own anyways, and the Shanghai stock index made its high a few years ago and has not been near it since. So we'll just watch and see, but I have little doubt that the communist authoritarians in Peking are going to do whatever they can to keep the bubble together, and their cautionary statements on the Bitcoin stuff I think are truly honest cautionary statements. I mean, it's insane speculation in a very costly item, and so it'll be interesting to see a few years down the line here about what really happens to all of these cryptos and Bitcoin things, and what's the market cap on these things into the trillions of dollars altogether.
Yeah, and of course, China has realized if you want to become the world's greatest military power, you need money to do it. The Soviet Union ran out of money trying to battle Ronald Reagan's Star Wars plan. But the Chinese have decided, okay, we'll have a free market economy, but a centrally planned one.
Yep.
But that's not how markets work. You can't plan for the stock market to continually climb for the next 1,000 years. It doesn't work without the dips.
Yeah. Yeah, if you take a look at the chart prior to when the Fed was formed, there were the boom and bust cycle, bull market cycles and business cycles were frequent. And of course what it did is, on each of the declines, it flushed out the weak hands and it flushed out those who were overborrowed and that sort of thing, and you then had a greater portion of the investment in the commercial and industrial community acting with caution. But then since the Fed came along, which would guarantee prosperity forever and nobody has to ever be cautious, then your business cycle have been less frequent. And but what this does is build huge distortions in the financial markets, such as, one was the dot-com bubble to March 2000. It was not a classic bubble, but it was massive speculation. And then it went down. I remember that one. Larry Kudlow, the broadcasting guy, said that you just had to buy the dot-com bubble because there was no inflation. Base metals and everything else, nothing was going up. It was an event all on its own. And then he gets to 2007, where you had strong industrial commodities, and he said you just had to buy the stock market because of inflation. And then now what you're going to get is what follows every bout of excessive inflation in financial assets, is that once it's over, everything deflates, except the real price of gold, and that then becomes the next place to play. So we were, since last summer, we're looking for gold stocks to decline perhaps into November. Well, we're going to extend that now, but that was based upon that somewhere late in the year, you could have the discovery of a credit problem. And this now is being discovered. So, but we're focusing on the golds because the next buying opportunity, which we will be able to, I hope, be able to get technically, is that then it leads to a lengthy bull market for gold based upon gold's real price going up. And remember that one of the characteristics of a great financial mania has been gold's real price going down, such that gold stocks underperform the S&P. So on the next rally for gold stocks, they can outperform the S&P. And this is where, on the longer term, we're going to have an interesting development whereby many equity fund managers who are not usually in gold stocks, there's going to be periods when the rise in gold stocks will be twice that of the rise in the S&P. And just to get that high performance, there's going to be many fund managers out there who would normally not buy golds, but because of the outperformance, they're going to have to get positioned in them eventually. So, but it'll be very savvy professional investors that'll be buying the forthcoming lows in the gold sector, and that will be our recommendation when the time comes.
Bob, one of the headlines that caught your attention today, Birchcliff Energy CEO sees very strong commodity action over the next 12 months.
Yeah, and they said that they were not hedged in any of their whatever they produce, which means if they're high producers of crude oil, they were not hedged, and bang, and you get crude oil off more than 10% in one day. But it was just those kind of headlines I grabbed because they show a lot of confidence in what's going on right now, and when right now is going straight up is the time when one should be cautious. So, a sign of the times, let's call it that.
We're seeing huge protests in Turkey because of their currency crisis. What's the story there, Bob?
Yep. We got to go back to last March. And the U.S. dollar index did a strong rally, mainly because other currencies were going down, and these would include, now the headlines then were that there's a sudden domestic crisis in South Africa, Argentina, and Turkey. So we flagged that as saying, okay, in a great financial boom year, the problems usually start in lesser exchanges. And then as we got into June, then you started having problems in China where authorities were doing this and doing that and whatnot. So then, but of course you can't call China a lesser economy or a lesser financial market. So then I came up with the term outlying market, as in outside of the serious financial centers in London and New York. And this has been a classic throughout history where in a boom year, the problems are discovered in lesser countries, outlying countries, and then this headline this week from Turkey, more problems. So what happens is in a financial crisis there, the domestic currency goes down and local rates go up, and you have a problem. And the central bank has effectively run out of reserves of U.S. dollars, and then they have to, unfortunately, tighten up to kind of protect their currency. And so this has been scheduled to eventually be discovered in the more important markets such as London and New York. I figured by October, November that this would be discovered. And it was ignored because beginning in September you had these strong rallies in commodities, aluminum and crude oil namely. And that kept the stock markets all together. But now the strong commodities are now weak. So I think this hit to the market is very important, and it may get overdone here because it is so fast. I mean, you get crude oil down more than 10% in one day. This is horror show stuff. So it will be volatile, but we're by way of conclusion, I'm thinking that this volatility now could be marking the end of the greatest financial bubble in history.
Bob, thank you so much for chatting with us.
Yeah, Jim, good to be with you, and look forward to next week.
My guest has been market historian Bob Hoye. He's the chief investment strategist for chartsandmarkets.com. He was speaking to us from Vancouver. If you have any questions for Bob, and he loves to answer them, you can send them to info@howestreet.com. Our YouTube channel is Talk Digital Network. Find us on Twitter @HowStreet. We're also on Facebook. I'm Jim Goddard. Thank you for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.